Hello friends. In the last lecture, I discussed about the partner's capital and the partner's current accounts. Basically, I discussed about the fixed capital method and the fluctuating capital method. That is, we are doing accounting for the partners. We are preparing the partners' capital accounts. Okay, so let's see a practical problem on that. It says A and B are partners with capitals of 60,000 and 20,000 respectively on 1st April 2015. So let us write down the facts. It says there are two partners, A and B. What are their capitals? Their capitals are 60,000 and 20,000 on 1st April, that is opening capital. The capitals are 60,000 for A and 20,000 for B. The trading profit before taking into account the provisions of the deed for the year ended 31st March 2006 was 24,000. What is the profit? Profit is 24,000. Okay. So now let's see what are the provisions of the deed. It says interest on capitals is to be allowed at the rate of 6% per annum. Interest on capital at the rate of 6%. That is interest at the rate of 6%. Okay. It further says that B is entitled to a salary of 6,000 per annum. Okay. What it is? We have to pay a salary remuneration to partner B as 6,000 per annum and not per month. Further, it says the drawings of the partners were 6,000 and 4,000 respectively. Interest on drawings for A being 200 and for B 100. Let us first see what are the drawings. Drawings are 6,000 and 4,000. And what is the interest on drawings? It is 200 and 100. Now what is the requirement? It says show how the profit will be divided between A and B. That means we have to prepare profit and loss appropriation account. It says and also show the capital accounts if they are fixed and if they are fluctuating. So we have two different cases. We have to show the capital accounts under the fixed capital method and we have to show capital accounts under the fluctuating capital method. But before that we have to prepare profit and loss appropriation account. See, you can always write down these facts in the rough work in examination. It makes your question very simple, very clear. Okay, so let's start with profit and loss appropriation account. I'll start with profit and loss appropriation account. You can write these answers with me. So let's start with profit and loss appropriation account. We have the credit side and we have the debit side. Particulars, amount, and amount. So what is the first point? We have the profit. What is the profit? Profit of 24,000. We'll say by profit and loss account 24,000. Second, we have interest on capital. The capitals are 60,000 and 20,000 and interest is to be paid at the rate of 6%. So what will be the interest? Let's see. We'll say 2 interest on capital. Okay. For A it is 6% of 60,000, that comes to 3,600. For B it is 6% of 20,000, that comes to 1,200. So the total interest on capital is 4,800. Clear? Third is we have drawings. In the P&L appropriation, we will charge interest on drawings. Interest on drawings is given by interest on drawings. For A it is 200 and for B it is 100. Total of 300. Now remuneration to partner. Remuneration to partner B, salary. To B's salary it is 6,000 per annum. Now what is left as profit to be distributed? 24,000 plus 300, that comes to 24,300 minus 10,800. So we are left with 13,500. So we have to distribute the remaining profit among the partners. Now see, the profit sharing ratio is not given in the question. So we'll assume that the profits are to be distributed equally. We'll say 2 profits transferred to A's capital or current account, and similarly the B's capital and current accounts. We have a profit left of 13,500. So we will distribute this profit of 13,500 equally among partner A and B. That comes to 6,750. Clear? So this completes our profit and loss appropriation account. Now the question says you have to prepare the capital account of the partners under the fixed capital method and the fluctuating capital method. Let's see now. First we will do fixed capital method. Under the fixed capital method, the capitals that are introduced by the partners, the capitals they are on the first day of the accounting period. Here the capital is 60,000 and 20,000. They will remain fixed. All other transactions or the appropriations we will do through partners current account. So under the fixed capital method, we will prepare two type of accounts. First of all, we will say partners capital accounts. Okay, here we have is okay, we'll make a combined partners capital account. Now let's prepare the partner capital account. We have two partners A and B. Under the fixed method, the capitals of the partners will not change. They will change only in case additional capital is introduced or some capital is withdrawn. Please remember this. This is very, very important. And in the absence of any information, you have to prepare under the fluctuating method. Let's see. We have the credit side. We have the debit side. Particulars A, B, A and B. Now, what is their opening capital? It is given in the question that A and B are partners with the capitals of 60,000 and 20,000 respectively on 1st of April 2015. Clear? So, we'll say by balance brought down how much? 60 and 20. Now, under the fixed capital method, the capitals of the partners will not change, and there is no additional capital introduced, or there is no capital that has been withdrawn from the business. So, we will carry forward the same capitals to the next period. I'll say to balance carry forward 60 and 20. So that completes our partners capital account. Clear? Now we'll record the transaction in the partners current account. Now let's prepare the partners current accounts. Clear? Let us prepare now the partners current accounts. These formats are very important to follow in exams, so be careful. We have the credit side, we have the debit side, particulars, partner A, partner B. Now let's see, we don't have any balances of the current accounts, but we have transactions in the profit and loss account that we will transfer to partners current account. Let's see the first transaction, that is interest on capital. A's capital is 3600 and B's is 1200. Now we will transfer this interest on capital on the credit side because it is a income for the partner. We'll say by interest on capital. For A it is 3600 and for B it is 1200. Any other income for the partner? Yes, salary. Okay, so we have by salary. For A there is no salary, for B we have a salary of 6000. Any other income? Yes, profit. By profit and loss appropriation account. How much? 6750 and 6750. What is the income? For the firm and expense for the partners, drawings. What are the drawings? It is 6000 and 4000. First of all, we will record drawings. 2 drawings, and then we will charge interest on drawings. To interest on drawings 200 and 100. Anything else we have? No. So we'll say this credit side is more than the debit side, so we have the balance on this side. We'll say to balance, carry down. So for A we have a balance of 4150 and for B we have a balance of 9850. So this completes a partner's capital and current accounts under the fixed capital method. Clear? Under the fixed capital method, the capitals will remain fixed. So the balance brought down is 60,000, 20,000, and the same balance we will carry forward for the next period. And all the transactions we will complete through partners' current accounts. Next, under the fluctuating method now. Now we have fluctuating capital. Under the fluctuating capital, we will prepare only one account, that is the partner's capital account, and all the transactions will be done through partner's capital account. Clear? So let's prepare the partner's capital account. Under the fixed capitals, we prepare two accounts, partner's capital account and partner's current account. Under the fluctuating capitals, we prepare only one account, that is the partner's capital account. And remember one thing, in the absence of any information, you have to follow the fluctuating capital method and not the fixed capital method. This thing is very important. So let's see under the fluctuating capital, partner's capital account. Now what is the balance in the capital accounts? What is the balance in capital accounts? The balance in capital accounts is, for A it is 60,000 and for B it is 20,000. We'll say by balance brought down 60,000 for A and 20,000 for B. Clear? Now let's see. We'll do all the transaction in partner's capital account only. What are the transactions we have? Interest on capital, income for the partners, right? Whatever transactions we have done in the current accounts earlier under the fixed method, now under the fluctuating capital method, we will do all those transactions through partners' capital accounts. We have interest on capital 3600 and 1200. We have salary. Salary of A will get nothing, B will get a salary of 6,000. We have profit. We say P&L appropriation account 6750 and 6750. Now we have the drawings. A will have drawings of 6,000. B has a drawings of 4,000. What is the interest on drawings? $200 and 100. Any other transaction? No. So we will get the balances now. Okay, we'll say to balance carried down. Now in the A's capital account, we have a balance of 64,150. And in the B, we have a balance of 29,850. Clear? So that completes our capital accounts under the fixed method and under the fluctuating capital method. So clear? Under the fixed capital method, we will prepare two accounts, that is the partners capital accounts and the partners current account. In the partners capital account, the capitals will not change and all the transactions will be done through partners current account. Then under the fluctuating capital, the opening capitals can change. So all the transactions will be done through only one account, that is the partners capital accounts. And remember, in the absence of any information, you have to follow the fluctuating capital account. Clear? The question is clear?